Money day, guys and girls. Welcome back to another episode of Market Mondays. Now, I know. I've been gone for quite some time when it comes to Market Mondays, but this episode is brought to you by your host, Bigger Vel. You are learning with Vel today, and I do want to share with you guys the importance of this episode. I am going to break down to you guys just how important the financial markets is in its entirety. I know when it comes to Market Mondays, I can be very technical based and show you guys a lot of the analysis, but today I want to sit down. I want you guys to watch this video with a notepad, to take some notes, maybe eat your dinner, and understand the importance of learning the fundamental aspects of the market, understanding what drives the market, understanding what creates a disruption in the market. There are so much different aspects that can create a buying or selling opportunity, which you're not going to see inside a technical analysis. You're only going to see these things by understanding them. So this is a game of chess, guys, not checkers. For any of you guys who are watching this video and you're thinking trading is something where you just use your software, you use your indicators that tells you to buy, tells you to sell, and you do it, great, well done. But this video is not for you. This video is for those who want to further their knowledge into the trading field, to become more of a technical / fundamental based trader, to become an economist, to become someone who is in tune with what happens inside and outside of their bubble. Okay? Bubble meaning someone that wants to be in tune with what's happening in the world. When you are in tune, guys, with what's happening in the world, you can see these moves taking place before they happen. So with that being said, we're going to get straight into this. Be sure to smash the like button, subscribe. You know the vibes, it's lit side. Okay, guys, so one of the main things that I want to teach you guys today when we're considering understanding the financial markets in its entirety is that the main things to look at, the main assets, is not the strength of the United States dollar. It's not the DXY. It's not any currency, the pound, the euro, the yen, the Swiss franc. It's actually the treasury bond market. The bond market is the Mac Daddy. Now, this is something that I teach my students, so I'm giving you guys a lot of free game. Now, essentially, guys, the bond market, okay, is correlated to interest rates. The two things right now that drive the markets, one being interest rates and the other being inflation. Inflation, as you may or may not be aware of, quite simply means the cost of living. You know that cup of coffee that you buy from Starbucks last year or 3 years ago, if it costed £1.50 for a regular cup of coffee and now it costs £1.75, so that the price has gone up, that would result to inflation taking place. Okay, when I was younger, you could go into a corner store and buy a sweet for a penny. Now the new penny is £1. So it's very important to understand the significance in inflation. The cost of living is rising, and of course, when we was in the first and second year of lockdown, essentially a lot of people were spending less, right? There wasn't as much money moving throughout the economy because people couldn't go out. People couldn't spend the money even if they wanted to. So essentially what happened was the central banks, okay, the Federal Reserve in this case from the United States, they said, look, in order for us to resuscitate the economy, we need to increase the inflation. The cost of living needs to rise. If people are no longer buying the same items they usually buy on a daily basis, we need to increase the price on those same items. If we increase the interest, if we increase the inflation, this simply puts people in a position where they're spending more, even though they're purchasing the same amount that they was purchasing before. So when we have a look at the bond market, we have two factors. We have a treasury bond and a bond yield, treasury bond yield. They are both inverse to each other. If one goes up, the other one comes down. Now, rising treasury yields can create capital losses in short term, but can set the stage for higher future returns. So when interest rates are rising, you can purchase new bonds at a higher yield, and over time the portfolio earns more income than it would have if interest rates had remained lower. But here's the thing. Rising yields may signal that investors are looking for higher return investments, but could also spook investors who fear that the rising rates could draw capital away from the stock market. So it is a double-edged sword. And a fundamental principle here is, when it comes to bond investing, if the market interest rates and bond prices generally move in an opposite direction, this means that when the interest rates rise, okay, bonds fall. So in other words, really, if the bond yields go up, that is a representation of interest rates, okay? If the treasury bond yields go up or down, that's because the interest rate has gone up or it's come down. So if interest rates go down, the treasury yield market will come down, which means the bond market would go up. This is really important, guys, because if the bond market goes up, then that means the currency, the dollar, is going to follow it. Wherever the bond market goes, the currency is going to follow it. So with that being said, I really want you guys to understand that a lot of you may be thinking about the latest strategy, how to perfect your technical analysis, but just like in school when you would do English lessons and they would pretty much tell you need to read this English book for homework, or whatever lesson they would give you, they would kind of tell you the answers are in the book. And in this case, it's the exact same thing. The answers are exactly in the book, guys. The answers that you guys need to understand regarding where the markets are going to go is right in front of you. It's online. It's public, free information. So I really want you guys to implement this, adding the bond market, adding the treasury bond and the bond yields to your watch list on TradingView so that you guys can track the movement of the bond market. If the bond market goes up, the DXY is going to follow it. We're talking about the US bonds here right now, okay? Now, unlike the DXY and let's say EUR/USD, if the DXY goes up, simultaneously EUR/USD is going to come down, right? Fortunately for us, with the bond market, it is not the same instant correlation. Meaning, if the bond market goes up today, the DXY could go up the following day or the day after. So there's a lag in place, which is really good for us because that means we actually have time. If we know that the bond market is pushing up crazily today, then actually we've got a 24 to let's say 72-hour window before the dollar should then follow it. So that gives us an opportunity to now find entries to buy as opposed to entries to sell. This is the most simplest way to understand the direction of a currency. And once you understand the direction of the currency, guys, you're 85% there. All you now need to do is find your entry. But if you know that price is going in the right direction, the hardest part is done. The hardest part is done. So I want to show you guys on the charts, of course, what the bonds and the treasury bonds look like. I want to add these to your watch list so you guys can see it. But I also want to discuss the importance of what's going to be taking place this week and what has been taking place throughout the last few weeks as well. Okay, so what we can see here is the US 10Y, which is the US 10-year yields, US 10-year bonds, excuse me. Now, I know my camera's in the way, so you'll have to bear with me on that. But you can see here, guys, if I click on my watch list, I'm going to type in US 10, okay? When you type in US 10, you're going to see the United States 10-year government bonds. You're going to add that, should be bond government TVC. If we add a Y to the end, we can also then see the the United States 10-year government bond yields. We're going to add those as well. Now, we've also got 30-year bonds. So we're going to add US 30. If we click on this one here, it says United States 30-year government bonds. And then we can press Y. And then we can also add the bond yields as well. Now, essentially, guys, looking at the 10-year versus the 30-year, one is going to show you the 10-year bonds are based off of the 10-year bonds and the 30-year bonds based off of the 30-year bonds. Quite self-explanatory. So you can probably find a move happening earlier within the 10-year bonds as opposed to looking at the 30-year bonds. Just like, for example, looking at a 3-hour time frame and a 1-hour time frame. Now, what we can see here is with the government bond, with the 10-year bonds, okay, we had a new high, price came down, it reacted off of the 79%, okay, which for those of you inside of my mentorship, you'll know this 79% is deadly, okay. We had that reaction, price pushed up, it failed to make a new high, okay, in terms of it taking out the previous high, but nonetheless, it did take out a couple of highs here on a weekly time frame, okay. Then price came back down. So if we fibbed from this low to this high, we can then see, of course, price has come back down. And so far, it's given us another wick reaction off of that glorious 79%, which, again, you guys know exactly how I feel about that for those of you who are inside the mentorship. If I remove this 79% because some of us would say, well, you know what, because it hasn't made a new high, I would not like to use that fib. Then actually what we can see here is price has come down first, reacted off of the 79, it's pushed up, then it's come back down, and this time it's reacted perfectly off of the Fibonacci, 62%. So with that being said, we could be optimistic here to believe that the price of the bonds would push higher. And as we know, if the price of the bonds push higher, then that would mean that the interest would be going lower. So on Wednesday, when the Federal Reserve comes out, they have said over this past year and last year that they are going to be reducing interest. That has been their thing. Okay, at one point last year, the inflation was at a 70-year high. Okay, I'm 30 years of age. That is over double my age. Okay, a 70-year high. My mum wasn't even alive then, or my dad. Okay, so that kind of puts into perspective how high this inflation is. Okay, so if the interest rate can come down, that is going to push up the price of the bond market. Now, from a technical perspective, it looks like we could be having that push to the upper side. Okay, it looks like we could get that push up, and if we get that push up, great, no one's going to complain with interest coming down. If interest come down, that means the repayments on your mortgages, on your loans, they're not going to be as bad. Of course, it's a double-edged sword because it means savers who want to save their money, of course, are not going to get as much value for money. Now, another hidden nugget here, guys, is for you to understand that when the banks provide you with a high interest rate, that's because they are encouraging you to save your money, to put your money into the bank. But when they're providing you with a low interest rate, that's because they want you to spend your money inside of the economy. Now, as you guys have all probably noticed over the past 2 years, if not longer, okay, there hasn't been a lot of money circulating in the economy. And what we do know is that the Fed have been bailing out a lot of companies worldwide. Okay, I say the Fed have been bailing out companies inside of the US, but all across the world, we're seeing central banks bailing out economies because they need the economy to survive. I want you to think of the economy as a confidence ball. Okay, if an economy is performing poorly, then foreign investors won't invest into that economy. So whoever's in charge of that financial state, in this case, it's going to be the Federal Reserve. Their job is to always attract foreign investment. That's their job. They don't want to come out and say to you guys, hey, our economy is falling to shit. We're going to be losing money. People are going to be on the grind. People are going to go through some hard times. They don't want to tell you that. They want to come out and tell you, hey, we know what we're doing. Yeah, okay, things may have been a bit rough recently, but things are going to get a lot better. They want to come out and they pretty much want to give you the best game they can to make you as a foreign investor believe that it's worth investing money into their country. So with that being said, I want to show you guys the bond yields. Okay, so we can see with the bond yields now, we have a completely symmetrical inverse reaction to what we're seeing on the bonds. Okay, with the bonds, we see they've been coming down, and only this last candle currently right now is bullish. And with the bond yields, we can see that it's been pushing up, and with this current candle, it's bearish. So it's the exact opposite to what we're seeing on the bond yields. Now, with these blue lines, I have got these unique structure levels. So actually, with these structure levels, what I've noticed, okay, is we've had significant moves off of these levels in the past. So why this is important is because history is always an important factor, right? And ever since the early 1900s, okay, we have seen that price has reacted off of these levels significantly, whether it's to the upside or to the downside. We have seen price bounce when it reacts. Well, we've seen price bounce when it enters these areas. And right now we're in this zone where price pushed up, it then came back down. Price pushed higher, it reacted again, it reacted to the upside, and now we're currently back in an area where price could, as it does look like right now, is reacting, which would be pushing down to the lower side. With the bond yields pushing lower, this would represent the interest going lower. With interest going lower, this would represent bond prices pushing higher. So this is really important to understand, guys. So another thing to understand here, guys, is that the inflation is the same as the interest rate. They're both intrinsically linked. So when the inflation rate is high, interest rates tend to rise too. So, you know, although it costs you more to borrow and spend, you could also earn more on the money you save. So when the inflation rate is low, in this case, it's what we think could happen from a technical perspective. That would mean that the interest rate, if the interest rate is going to be coming down, that would mean that inflation is going to come down with it. They are both intrinsically linked. They're twins. When one goes up, the other one follows it. So right now, a representation of the Fed saying that they want to reduce interest rates, okay, and reduce the inflation would actually show us what we're seeing right now. And that is only from a candle perspective. From a candle perspective, we've got a bearish reversal forming right now, but that isn't to say that that is going to be the case. Now, we could get price just pushed down, maybe to make a higher low, and then push up to make a higher high. That could be the case, okay? But nonetheless, we want to see price coming down. Of course, we want to see price coming down. I'm human, just like you. I don't want the rate of inflation to be high. I want things to be affordable. I don't want things to cost too much. So with that being said, it's important now that we can correlate the bond market with the DXY. So when we have a look at the bond market, okay, on a weekly time frame, we can see prices pushed up and then it's come down. Yeah. Now, the DXY, of course, has been very manipulated recently. And the reason why it's been manipulated is because this game of cat and mouse, right, is a public presentation that needs to be perceived to be strong. Okay, as I told you guys, economies need to be perceived as strong. The second an economy is perceived to be weak, it will lose foreign investors. It will lose a ton of money. So when the bond market, we can see right now, this candle is currently bearish, right? And the bond market candle is currently bullish. If we check the last several weeks, 1, 2, 3, 4. So let's go back to 4. Where's the DXY? If we check the last 4, we can see we've had 1, 2, 3, 4. Now, out of the last 4 candles that we can see here, this is really important to understand, guys. Only one of these candles has matched up what the bond market has shown us. So what is that saying to us? If the bond market is meant to show us the direction of the currency and the bonds have been coming down, but the currency has been pushing higher, then that shows you that there is a mass manipulation at hand here. That shows you that one hand is lying. And I can promise you this, guys, the hand that's lying is the dollar. It is the US dollar. If you guys have seen the economy just last month, okay, Joe Biden has borrowed another $1 trillion in the last quarter. They are borrowing money, or they are printing money, should I say, not borrowing, excuse me. They are printing money. Whenever they run into a problem, they're printing. So essentially, it's a ticking time bomb here, because what they're trying to do is they're trying to tell you, hey, our economy is indestructible. But essentially at some point, the bomb is going to explode. And when the time is up and the bomb explodes, we are going to see the true direction of the US dollar. Right now, for example, okay, the stock market is a credible factor to the strength or weakness of an economy. So when you have a strong stock market, it represents a strong, stable economy. So what's happening is the Fed have been pumping the stock market. Very simply, they've been pumping the stock market, which means that from the outside looking in, hey, America, there's nothing to worry about. The stock market is good. It's at an all-time high. There is nothing to worry about. But what's important to understand here, guys, is to look between the lines. Look beneath the cloak and dagger. Okay, the cloak and dagger right now in this scenario is that one is showing us that price is going up, which means it's positive, but then the other is showing us price has been coming down. I've been looking and I've been trading for 7 years, so I can tell you, in my first 4 years of understanding the bond market, when the bond market would push up, the DXY would follow it. Simple as. Now, over the past maybe 16 months, I'm seeing a mess. When the bond market pushes higher, the dollar's not really following it. So that has shown me, and you guys can check the charts historically for yourselves to see, that has shown me that clearly there is a diversion, there is a manipulation at hand here. So it's really important to not look through what's happening, because if we can understand that there is a manipulation at play, then that means that the overall answer is that we shouldn't even be involved in trading the dollar. We shouldn't be involved because it's just being manipulated. If something is being manipulated, that means it's unfair, technically, right? If something is being manipulated, that means that there is a huge disadvantage. And that disadvantage right now is that the markets are not lining up with what they're meant to be. A classic example, in my first 4 years of trading, first 4 to 5 years of trading, what would happen is if the stock market would go up, gold would come down. Now what you'll see is gold will go up and the stock market will go up. Now what you'll see is the DXY will go up and gold will go up with it as well. Reason being is because if you guys can remember on my previous video, but I'll happily explain to you guys now, the Federal Reserve came out publicly and they mentioned that they are buying gold. So even if the strength of the dollar is going up or going down, they are buying gold, which means that the effect of the dollar has now nothing to do with the price of gold. Because now a foreign entity is buying gold. It's buying gold at a truckload. They are buying billions and billions and billions of dollars worth of gold. So what that tells you guys is right now we are in uncharted times. We're in unprecedented times. Of course, we're seeing global pandemics, we're seeing global destruction. So essentially, when any economy is perceived to be uncertain, investors will always want to put their money into safe assets. And that's the reason why central bankers are putting their money into gold, because even they don't believe what they're saying. If they believed what they were saying, then they wouldn't be buying gold. If they believed what they were saying, guys, they would not be buying gold. That is the clearest and most easiest way for me to show you guys that the markets are being manipulated. Because for many basic traders, for many beginner traders, I should say, one of the first few things you learn is that the DXY is the strength of the dollar. So if the DXY goes up, then that would mean XAUUSD should come down. Euro USD should come down. GBP USD should come down. But what we've been seeing with gold is that even though the DXY is pushing up, gold is still pushing up with it. So it's very important for us to identify these things, because when we identify them, these should be a big red light flashing on our dashboard to say, hey, there is a massive problem here, and at some point it's going to get fixed. And at that point, it could be too late for investors. Investors could be all the way fully diverse, fully involved in maybe trading the dollar, fully involved in purchasing gold, so that when the correlation does come back, a lot of money would be lost in the markets through traders reading false signals. You know, when you meet a girl at the bar and she gives you a false signal and you think because she's spoken to you now, all of a sudden you deserve her telephone number, and she says, bro, what are you thinking? Like, just because we had a conversation doesn't mean I want you to have my number. That's exactly what's happening here with the markets. The markets are showing us one thing, expecting us to jump the gun, to get excited, to get carried away, and to actually falsify an event, to make an event feel like it's real, so that as soon as reality comes back around, boom, game over. Now, with that being said, of course, I can't not talk about crypto. Okay, the crypto market has, of course, made a new all-time high. Over the past few weeks, we saw crypto reach as high as 73,000. Let's call it 74,000, okay, because we was only a few dollars off that 74,000 number. So we saw Bitcoin reach a $74,000 high. And a lot of investors would think that crypto is going to continue going. The news would tell you the exact same thing. Bitcoin's at 74,000 now. It'll probably reach 125,000 within the next 3 weeks. They will tell you this type of information because they want you to keep buying at a high price, so that when they sell the majority of their holdings, price will crash, price will drop. Whenever you hear the price of an asset depreciating over 20%, that is considered a crash. So the reason why you will hear a lot of the times on the news or across social media, Bitcoin has crashed, is because Bitcoin has either dropped 20% or more. And what they're doing is that whole word crashed as a whole. That word crash breeds panic. It breeds fear. It breeds a certain distinctive feeling of I need to get out now. Okay, a certain feeling of urgency, which is if the market has crashed, it's going to continue crashing. But really, a 20% decline for something like Bitcoin, I mean, well, let's have a look. Let's see what a 20% decline would look like. So from 74,000, let's say up here, down to here, okay? The market came down to here. It came down 19.10%. So if it had came down 0.9% more, you would have heard the news, the media saying Bitcoin has crashed. Now, I believe Bitcoin will continue to come down lower, and we will hear at some point the news outlets say that Bitcoin has crashed. But that is just for investors now to sell so that they can drive price down lower, and of course they can repurchase at a cheaper price and repeat the same cycle over and over again. Now, what am I looking at for Bitcoin? Well, for Bitcoin as well as for the NASDAQ, because the NASDAQ is actually tied to Bitcoin. So what you'll find is because Bitcoin has now ETFs, which the ETFs are on the NASDAQ, it simply means that when the NASDAQ is pushing up, it's most likely Bitcoin is going to follow it. And you can see that for yourself, guys, if you check it out and add the NASDAQ to your watch list. So for now, what we're just seeing here inside of this formation, we're seeing a new high. Price came down, took out the previous low. We're then failing to get a new high. Now, anytime we see price failing to create a new high, guys, this is a major indication that price is about to change. And because of that, we need to understand the significance of what happens when we fail to get that new high. Now, when we fail to get a new high, we need to see what price does. Does price go on to make a new low? Does price just continue consolidating? What's happening? Now, we can see here price failed to make a new high after here. Price made the high, it came down, it failed to make a higher high, and then price started dropping off, closing beneath all of these current lows. We closed beneath this low, this low, this low, and even this low over here, as well as making an equal low down here. So it was quite clear to see that now the structure had changed from being bullish to now being bearish. Despite what you would hear on TV, despite whatever signals you might hear inside of someone's Telegram group chat, Bitcoin structure on a weekly and daily time frame, or on a daily time frame, is now bearish. So that would mean over a number of days, we would expect the price of Bitcoin to fall. It doesn't mean we're expecting it to fall today or tomorrow, but over a number of days. For example, when Bitcoin failed to make a new high here on the 10th of April, it's now come down to the 29th of April, which is 19 days later. We're seeing the effects of what happened when price failed to make a new high. So I'm showing you guys the importance of understanding things from a higher time frame, from a bigger picture. Because if we can understand the bigger picture, we can understand the direction. Once we understand the direction, we just need to find our entry. Now, for a lot of my students who will watch this video, I want to brush up your skills, and I want to test you guys to understand and to identify probable, highly probable entries. Okay, I'm going to go onto this chart formation, and I want you guys to tell me, maybe in the comment section below, you'll send me a message, but I want you guys to highlight and have a look for yourselves. Highlight where you would sell from, highlight where you would buy from, if any. Highlight what the reasons would be for you guys to buy against what the reasons would be for you guys to sell. What you would find is that there are more reasons to sell than there is to buy. Now, even so, with that being said, I want to make it very clear to you guys that Bitcoin, I think personally, is something that is very seasonal. I don't think it's something that should be traded on a daily basis. I think it's something that, when the traditional investments, when the traditional sectors fail, Bitcoin tends to get quite popular. What do I mean by that? Well, when the currency markets tend to get a bit dull, I think investors, when they're not too certain of how the markets are moving, or when they're not too certain of the confidence of certain economies, I think they want to put their money into appreciating assets. Bitcoin has been the best appreciating asset over the past decade. It has outperformed every investment out there. So it's really important to understand, guys, that for us, we may have a few 100,000, we may have even a few million, we may have even a few 100 million if we're lucky, right? But for those who work in the billions and the hundreds of millions and the hundreds of billions, these people really want to make a huge profit. So to do that, they are going to picture and wait. They're going to picture their entry. They're going to find a price that suits them, and they are going to wait. So guys, if they can wait for an entry to become profitable, my question and my challenge to you guys is to do the exact same thing. If you guys work a 9 to 5 right now, you wait 30 days in a month to get paid, the majority of you, meaning you get paid 12 times throughout the year. If you can be patient enough to get paid 12 times throughout the year, then you should be patient enough to catch a highly profitable trade in the markets, because trading can pay you instantly. right? Now, for those of you who are new to my channel, I just want to make it clear that I do have a Telegram which you guys can get access to. It is for free by clicking the link in the bio. I provide trades, I provide a further insight and depth of analysis. I also have a paid channel where I provide you guys with a number of trades, and what I do inside of those trade rooms, my VIP trade room, is I provide you guys with long-term trades that we can hold and short-term trades that we can benefit from off of a daily basis too. With that being said, we are still currently sitting inside of Euro AUD. Now, the Euro AUD trade, if I just briefly brush over this, the Euro AUD trade was from up here. We took this trade right with this candle. Okay, so with this candle over here, we took this trade. The reason why I moved this is so that you guys can see the candle. We took this trade here, and we're currently still sitting inside of this trade with our second take profit target hit. Now, this was based off of a daily time frame. Okay, I gave out the second Euro AUD trade also inside my VIP community, but mainly for the free channel so that you guys could benefit from this trade too. And of course, that trade hit all take profit targets. But I really want to touch upon the fact that this entry that I highlighted off of the daily time frame means that because I've taken a trade off of the daily time frame, I need to manage it off of a daily time frame basis. Now, if you guys can recall, I mentioned with Bitcoin, it took 19 days once we saw that price fell to make a new high for price to bottom out. Well, based off of that factor alone, that would tell us that if we're going to take a trade off of a daily time frame, we need to give it around 19 days, if not more. Sometimes it could be a lot less. Of course, we hope for it to be a lot less. I hope price could just fly down all the way now. But if it doesn't, then I'm prepared to sit in this trade risk-free because my stop loss is in profit, and to pretty much allow this trade to do what it needs to do. So I want to make it very clear, guys. I don't want to take up too much of your time, even though we have a ton of value. We have a ton of different topics we could talk about. But what I want to do is I want to provide you guys with the accessibility of booking a call with myself. If you're watching this video and you want to develop your trading skills, then I would strongly urge you guys to consider my mentorship program. But before you consider paying for my mentorship program, I want to give you a free one-to-one session that's going to help you guys understand what I do, how I do it, but most importantly, how I can benefit you. So if you're watching this video now on YouTube, it's very, very, very appreciated if you guys can smash the like button if you haven't already. And of course, share the video with a friend, but understand all of the key topics that I've spoken about today. Understand that the bond market is the Mac Daddy. Understand the correlation between inflation and interest. Okay, understand the importance, guys, of looking at the bond yields and the bonds. If one picture is not clear for us, then we want to use the other picture to find out if we can get a clearer understanding. Meaning, if I can't find a sell on the bond yields, but I can find a sell on the bonds, then that would mean that if the bonds sell off, the yields will rise, vice versa. This makes it easier for us to understand, and it then, of course, allows us to have a direction, and it gives us time. Okay, so of course, keep these on your watch list. Monitor how the bond market moves with the DXY. Monitor the lag. Maybe you're seeing a 2, 3, 4 day, 5 day lag, but monitor to see how it works. Monitor to see the direction. And of course, once you guys start to get confident with understanding the direction, you can start trading this strategy. This is something that all of the high net worth individuals do. If you go onto Bloomberg and you listen to the Bloomberg radio, Bloomberg live broadcasting channel, the main topic of discussion always is the bonds, the treasury bond market. Is the bond market selling off or is it buying? Are people buying bonds? Are people selling bonds? So it's important, guys, to understand these things and practice them. Now I'm going to end the video there, but I'm going to tell you guys, thank you if you've made it this far. I appreciate you guys for tuning in. You have been learning with Vel today. And as always, be sure to remember that every day is money day. Peace.